year, the exposure at default is 95, but the person is unemployed. And you know that there could be some problems to pay back the loan, and then the loan loss allowance, you increase this year by, imagine 7, so loan loss reserves is 8, 7 plus 1. Loan loss allowance is loan loss provision. So the accumulated, so the accounting value of this loan right now is 87, and it was here 96. You see what happens? And then in the third year is in default. And you think that, given that you have a collateral, a guarantee of the house, you are going to recover 50. Okay? The exposure at default is 95 because he or she didn't pay you anything. The loan loss allowance of this year should be, given that is 37, because you, 37, yeah, that's right, because you are going to recover 50. And the loan loss reserves should be 45. You know what I mean? This is the accumulated, and this is the profit and loss account. What you are expense this year.
But in the opposite it happens, like the PD is lower.
When the PD is lower, you can reverse this one. Imagine that here improves the credit risk, and then this year, because this person
employment rate
the salary of this person is larger, etc. So you can reverse this, and then you can do a loan loss allowance of this year of -5. This is an income. If you look at the COVID crisis, look for a new related to JP Morgan that in 2020-21 reversed a lot of provisions because they made a huge provision in 2020, and then this provision reversed and generated income in 2021. This was one of the, I know a lot of cases where the provision reversed because they predict, they simulate the macroeconomic scenario worse than it was in the end, and then they reverse the provisions that they made the previous year. You know what I mean? Yeah. And because it's expectations, it's not realized numbers. And that's important. And when you are in stage 3, you are going to apply PD of 1. Okay? PD of 1. PD probability default of 100%.
You said before that, okay, there is a probability of default, but also the probability of, like, you can recover that money so that it compensates the default. So when you calculate the PD lifetime, you take into account that recovering probability.
You need to take into account because in the end, you are telling that it's in default and no recovery. But I will explain the other parameter recovery in the practical example, because I would like to go step by step. In the second real example that I put you, I introduced this. And the timing, where you are in default, which is the timing that I'm going to recover, because I go to the court case, and I was working with an Italian researcher, a very good Italian researcher, that he has granular data on an Italian bank, and we realized that depending on the court that you go, there were courts that were more efficient and the execution of the guarantee was faster than others. So this affects the parameter also. This affects the parameter, time to recover. That it affects the loss given default, because you need to estimate the current value. If you estimate that you are going to execute a guarantee and you will be able to sell this guarantee to the market in 2 years, the value is not the same, given that the guarantee is the same, that you expect to recover in 7 years. Because in this court, the things are slowly and it's very difficult to execute the guarantee, etc., etc. Because the judges are more social oriented and they don't want to execute the guarantee because people are more sensitive, social sensitive to executing the guarantee from the bank. Okay? It affects a lot of things, cultural things, etc., law, etc., to these credit risk parameters. the funny thing that you need to take into account, okay? And always, you need to remember that banks are strategic assets for the countries because the funding, the most efficient funding with a lower interest comes from banks, not from investment funds. So you need such a good supply of loans to inject liquidity in the economy at a lower price. It's possible because it gives competitiveness to firms in the market because they have a lower cost. Financial expense is lower and then they will be more competitive. You know what I mean? Eh? You know what I mean? Okay. So this is what I explained between the difference between PD 12 months and PD lifetime. And we are going to jump from PD 12 months to PD lifetime when there is a significant increase in credit risk. You need to apply professional judgment. It's one of the most important things for my students or the undergraduate is try to develop the capacity, the ability to develop professional judgment. Okay, it's not accounting about the standard. The value is how you justify your accounting solution. Is the most important thing. Okay, so if the loan is in default, so if the borrower is 90 days past due, we assume that the PD is 1. We are applying PD lifetime. The probability of default is 100%. Okay. Always you need to extract a lot of information. The most interesting data about how the market views you is if you are a large company, you have CDS, credit default swaps. The pricing of these credit default swaps gives you a lot of forward-looking information. The credit default swaps, because you have credit default swaps for bonds, government bonds, and then you can see how the market is, because credit default swaps has forward-looking information because are insurance product to hedge against the credit risk, the default of a country, of a company. In Spain there are very few firms that in the market have you can hedge this position through credit default swaps. You can do it with the sovereign bonds and with the largest firms. Okay, you can purchase credit default swaps in order to hedge your position because if something happens, the insurance firms will pay it. Okay, the credit default swaps. The pricing, you need to take into account that the most liquid credit default swaps is the government bond 5 years. Okay, for 5 years. You want to hedge the position in 5 years, the maturity in 5 years. But for small and medium entities, you are not going to have credit default swaps in the market. It is only for the largest firms. Okay. This reduces the profitability of your investment, but in the end, you are adding a hedging position to the default of your borrower. Okay? And you need to take into account this. So credit default swaps, supervisors are going to pay attention to credit default swaps. Another forward-looking information that is important because in an expected credit loss model, the most important one is not the current macroeconomic situation, it's the future. And how the market sees the future, you need to use forward-looking information, and the most important forward-looking variable for credit risk is credit default swaps. Okay. Okay. So we are going to see some small examples in order to see which is your opinion about this situation. Okay, I give you 1 minute to read this or 2 minutes. And then let me know what you think. Should we apply PD 12 months, PD lifetime? Is it stage 1, stage 2, or stage 3? What do you think in this case? I'm going to provide you some small case studies in order to develop your knowledge, okay? And then we will make some real examples, okay?
Sorry?
Bank X provides a tranche. What's that?
A tranche is when you are issuing. You don't know what is a tranche? When you are issuing some bonds or some instruments, you can issue different tranches. For example, subordinated debt is the riskiest one. Senior debt is the most secure. So first, if there are losses, shareholders are going to absorb losses. Second one, the subordinated. Then mezzanine. Mezzanine are the creditors that are between subordinated ones and senior debt. For example, here, if you look at the liability and equity side of every firm, this is the equity. The first absorbing losses if something happens in the company, the first are the shareholders, right? Thus, the cost of equity is larger. Why? Because required return from shareholders, given that they are giving more risk, they are going to require a larger return. Okay, that's the cost of equity, which is the value added by your managers in your company. The return on equity minus cost of equity. Do you remember last week that I showed you which is the shareholders value added by this bank, etc. The difference was this. In capital IQ, they estimated 12%, but this should be estimated individually, depending on the situation of the bank or the situation of the firm. Second, you have the subordinated debt. Okay? Creditors that are below the shareholders, but are the riskiest one without guarantee, without any guarantee. The second one are mezzanine. That are between subordinated debt and senior debt. And senior are the more secure.
Some core bonds from the same company have different.
Of course, different use. Of course, because it depends on the guarantee. It depends on, for example, covered bonds are the most important one because not only they have a specific guarantee, the core bonds, what we call in Spain cédulas hipotecarias. Remember the Red Spain covered bonds last week? That covered bonds are those cédulas hipotecarias that you have a specific guarantee of a specific assets with a rating of, for example, AA. Okay? And then these assets, in liquidation or in bankruptcy chapter, cannot be used by the other creditors. These assets will go to this senior, okay? To the covered bonds, okay? Okay, so any question that you have, you can ask me.
And the deposits, what are they?
Well, the deposit are more than senior. It's a good question. 60% of the liability side, this was for industrial firm or for every firm. In a bank, you have this, because they have a preference. They have a special preference because they are, you have the society. In the bank, you have, in fact, the equity in the bank is lower. You have subordinated. You have mezzanine. You have senior. And you have deposits. The highest preference is deposits with a maximum of 100,000 euros. In Europe, in US is $250,000 per bank and per person. If you are married, you have 100,000 euros in this bank, and your wife or your husband has 100,000 euros in this bank. Okay?
So, question, so banks disclose information yearly, is publicly available, or you have to download data? Let's say I want to see Santander's financial statements, or whatever bank it is, can I access publicly to that information?
They are going to give you this information in the notes, how much subordinated debt they issue, and is still active, how much they are in how much is senior, how much.
That's because they're publicly listed, like in the States, or that's because that's regulated?
Usually it's because of regulation. Although you are not listed, imagine, a bank is not a listed bank. They are going to provide you a lot of information. And also not only on the amount, also on the maturity. They have some deposits that are for the next 2 years. They have some, in fact, one of the measures that they need to provide to the European Banking Authority, and you can download from the European Banking Authority transparency exercise, is how sensitive are your depositors to movements in interest rates. Okay? Because of they need to develop a model, behavioral model about how your depositors move when the interest rate change and when you are not repricing the deposits. In banks you have a lot of information because they are regulated, they are very well supervised, and you have a huge level of information. In fact, we need to review this. So please, I didn't read this, so I need that you read this and we can. So in this case, the bank provided a senior debt to this, so they have some guarantee on the assets of the company, so it's more secure than a usual loan. Okay? Similar to a mortgage loan, because in a mortgage loan you have the guarantee, and this guarantee is not for the other creditors; it's for the bank. Okay?
What determines being on each stage? Is there a threshold of debt or something like that? That's the part I don't understand.
No. At the beginning of the transaction, you should classify this loan in a stage 1. And then only when the PD, the probability of default, is getting worse, because increase the credit risk, for example, because of this employee works in a sector that is underperforming, or there are a lot of people that are firing in this sector, then this PD could increase. And then you need to think whether you should change this loan from stage 1 to stage 2.
So that's why,
Did you read everything?
Almost the last part, but I have a question, follow-on question. So let's say you're in a firm side, and you get like a syndicated loan of 200 million, and then that's why bankers usually every year ask for like a renewal of financial statements and stuff, because they want to see your health,
Absolutely.
financial, and the covenants, and then
And you are listed every quarter.
and then just adjust the PD, right?
Right. Yes. In fact, they fit the model in order to make these estimates. But remember that the PDs and LGDs usually are collectively assessed. Usually, but because you can make an individual analysis of one specific firm that is very important for you, and then you can make this effort. It's more costly to follow and to estimate the PD of this, because it's very important for your bank, because the loan is not 100 millions, it's more than 2 billions. So then you need to make an individual analysis on that.
Sorry, what is it?
Let me to read everything, and then you can ask me anything. Let me to read again.
So we think of the example.
Okay, so I read. Did you read it?
Yes.
Okay, what do you think? The question is, should we move this loan to a stage 2 or not? Is a significant increase in credit risk in your opinion? And then ask me whatever.
I was just gonna ask what does the covenants means, but he just explained.
Okay, covenants are those, one question to learn the covenants in the market, you can go to the Securities Exchange Commission and to put credit agreement of a company that is listed. And you will have the covenants that are imposed by the banks in the credit agreements to facilitate loans to this company. The covenants are those thresholds that, imagine, if your net financial debt over EBITDA is larger than 4, you cannot distribute dividends, or I have the right to be paid in full the loan. I am the bank. I put this condition. Then I try to manage your level of leverage, not to increase a lot, in order to don't reduce your ability to pay me back the loan. You know what I mean? Usual covenants used in the credit agreements. It would be nice if you can have a look to examples. Select any company in the stock market in the US. Put in the Edgar database. Edgar database is the database of US listed firms. Not only US. All of the things that are listed in the US. And then put credit agreement. And then look for the covenants that are in this credit agreement. In US are published available. In Europe, you don't have this information. And this is important because imagine that the debt to EBITDA is larger than 4 and you have a covenant of 4. Then the firm belongs to the creditor because the creditor can ask you the anticipated amortization of the debt and you are in trouble. Imagine that you're an investor and I'm going to put money without knowing this. I need to make a due diligence in order to know what are the conditions of the... But imagine that the company is listed and I don't know anything. What happens in Europe? You don't know anything. And you are investing in a company that is closed. That's the reason that in empirical research, in accounting, we focus on those regions that are close to the covenants because are where the managers have incentives to manage the accounting numbers in order to reduce the probability of being controlled by the creditors. Do you know? Imagine that you have a covenant of 4, net financial debt over EBITDA. So the debt that you have with banks divided by the ability to generate cash flow. If this is more than 4 times and you have a condition of 4 and you are in 3.90, you have incentive to reduce manipulating accounting in order to be far from this covenant. Okay? Or imagine that you are 4.05. You don't want to give the right to the bank to do it. That's the reason that when we analyze earnings management, debt management, frauds, etc., we focus on companies that are close to the covenants. You know what I mean? Because perhaps the 3.95 that you see, perhaps is 4.10. And then it belongs to the bank. Okay? And then the bank can hire you to make an analysis, forensic analysis, whether the number is 3.95 or 4.5, etc., etc. You know what I mean?
Mm.
So you need to take into account the incentives. In economics, what you are going to analyze, everything is incentives. It's about incentives. Agent and principal, economic incentives to generate economic growth, etc. Everything is about incentives. In accounting, it's the same. In fact, accounting is a portion. You need to have a good background of economics. In my case, was statistics, but it doesn't matter. And then to use in one business area, it would be very useful for you because in the end, you are trying to be holistic. Okay, that is important. In this case, what do you think? Should we move the loan to stage number 2? Should we apply PD lifetime? Why?
Because I think the present looks bad, but also it's saying that future doesn't look right for the environment in that industry, and it's important for business to not overestimate revenues for not only for bank but only for other type of creditors.
Okay, no, good question and good answer. We need to move to stage 2 because the economic outlook is getting worse for this company, and it's close to leverage ratios, macroeconomic change, breaching the covenants, etc., etc. So you have a problem. Okay, we need to move to a stage 2. Okay? We don't need to wait until the borrower is in default and not paying. We don't need to do this in a expected credit loss model.
That would
Okay.
be moving to stage 3, right?
Then
If we wait until
it would be in a stage 3. But in the past standard, we only recognize the provisions when we have the problem, not the problem that too little, too late. Okay? And that's an important question. Second one. Let me read. This example is perfect for explaining you one thing that is very important when you are analyzing whether you should move from stage 1 or stage 2. What do you think? Stage 1 or stage 2?
Can I ask something first? Can you jump a loan? Let's say you're in stage 1 because you already gave the loan. You can jump directly to stage 3.
Sorry, I didn't.
Can you jump directly to stage 2?
You can do it, but the most important thing here is when you granted the loan, what was the situation and the expectations at that time. Because when you grant the loan, you are in stage 1. And you need to estimate a change between the starting point, is when you granted the loan, and when you are making the evaluation. So, is there a significant increase in credit risk from the beginning, in this case, or this was expected when I granted the loan by the bank? Because imagine that I grant the loan, I know that you are riskier, I'm going to adjust the pricing. I'm going to ask not for 4% or 5%, for 8% or 9%. And I have a portfolio of loans, this should be covered the default of some borrowers. But the point that I want to make is that in this case, the important difference is
that in forward looking, we can see that that there is still risk, but the initial risks were higher than the prospective risk because they are saying that they are going to have more flexibility in order to pay loans, that they obtain bad results, but they were already expected at the beginning.
This was information that was taken into account at the beginning. That's the point. And then it affected the pricing. I increased the pricing of this transaction. The pricing of the loan transaction is interest rate in the contract. Okay. In the end, we are accounting for papers. The assets of the bank in the balance sheet are contracts, nothing else. And we need to value this contract. That's the funny thing, you know what I mean? And then, you are absolutely right, this information was expected at the time that I was granting the loan. I had this information available at the time that I granted the loan, so there is no significant increase from this time to the time that I am evaluating the loan. Okay?
Professor, a question. The company is also cyclical, but does the fact of the company being cyclical, even though we can anticipate very little cycles, make it more risky than a normal growing company? even if we know those cycles doesn't affect, not affect at all the stability of the contract.
Okay, if you know and you can justify that those cycles,
Like
every crisis is different, and the nature of every crisis is not the same. Could be related, but we are not going to suffer an identical crisis from today to the previous ones. But could be the origins seem similar in real estate. I don't know the origin in real estate. We are not going to have the same crisis because real estate in 2008, the banks invested. They have all the operating risk. If you look at the banks were providing financing to real estate assets and also were shareholders of some real estate firms. They were shareholders and they suffered all the operating risk because if you look at the real estate firm, from the assets, we can suffer a correction, but not a huge crisis only with real estate that we suffered in the past. You have the equity and the debt, no? So a lot of banks and saving banks, for example, in Spain, provided financing to them as a creditor, and also were purchasing shares of this company, and then you are giving the operating risk of the assets, of the real estate assets, because you are shareholder and you are a creditor. You have a problem because in the end you can suffer
interest conflicts.
not, well, there could be some interest conflicts, as you mentioned, but also you are giving the operating risk of a firm that is very cyclical. Then ECB don't allow you to be shareholder of a real estate firm, and also reduce the debt. You cannot provide funding because it's very costly in terms of regulatory capital for the first phase of promoting the real estate assets. And this is very costly because we are going to pay these scales of credit in the first phase of real estate. And then these firms should be financed through investment funds that are much more expensive than the banks. The banks coming to as a creditors after when you are almost finishing the buildings or in a phase that is not the initial one. And then you are translating more cost to the economy, more cost to the people that want to purchase the flat. You know what I mean? So that's the problem. Regulation moves credit flows from one sector to another. And right now we have a problem not moving flows to the first phase of real estate assets in Spain. Okay, it's very difficult to obtain. You can ask anybody that you know from this sector that banks are not as relaxed as they were in moments previous to the financial crisis.
They asked a lot of, I know they asked a lot of money from so it's to refer a real estate firm that's based in Spain, and the amount of the money, there's a project that was valued at 15, they wanted 4 million of our money plus 40% of sales already to actually put money.
Absolutely. The
You know,
conditions are stricter,
And
much
that's insane.
stricter than before.
That's affecting.
And it's very difficult. It's affecting your cost, and you're translating the cost to the citizens when they want to purchase this flat. So in the end, regulation is explaining as a first driver in the real estate sector. Also, there is a problem of supply because mayors in every town are those who decide how much supply of land can I sell to real estate firms. Also, it affects, but also regulation, especially credit standards. Okay, Natalia?
Do different industries have different metrics to evaluate their risk? Like the banks, for example, you provide a loan to depending on the company, the nature of the company you provide the loan to, you have different metrics to.
Of course, in fact, in the bank, credit risk analysts focus on specialized
Okay.
industries. For example, there are credit analysts that are experts on hotels.
Mm.
They need specific metrics
Because
of
you, know,
hotels.
you have to know very well
Absolutely.
the nature of
The leverage of the sector is different. If you look, for example, you want to see which is the weighted average cost of capital of every sector. Aswata Modaran provides you in his web page the weighted average cost of capital for the whole year. Every 5th January, he publishes. No, you will see that the optimal capital structure of the sector is totally different. Nothing, we cannot compare an industrial firm to a financial firm, whether the leverage is much larger because they are making financial intermediation. So you need to be an expert on one sector. From time to time you move from one sector to another, but it's very different because the business cycle is different. Imagine winery. You are producing wines that you are going to sell in 15 years or 20 years if they are grandes reservas. Or crianzas, 3 years. Imagine, you are investing right now to obtain money in 4 years, in 3 years. So, and you have the annual financial statements, but the business cycle 3 years or 4 years minimum. So it's different. You need to take into account always the business model of each sector, and that's very important. How you learn to my students, which is for my students of the bank, the Master in Banking and Financial Regulation, how they learn the different business model of different industries. Always, they learn a lot in a very simple way. In the most simple way to learn the business model is to learn to look at the profit and loss account. If you look at the profit and loss account, you will see how they generate revenue. Then you look at the cash flow statement, how they generate cash flows, and then you will see. And then you need to read the notes related to profit and loss account and to cash flow statement. This is the most efficient way to learn. Is the way that I learned a lot for different business models that I didn't know. Okay? So in this case, I think we can keep in stage 1. Okay? It's a question of professional judgment, but it's important to know that you can justify that this company should be in stage 1. Okay? Next one. I give you 1 minute.
Is it possible to stay like on stage 1 but rise the...
Of course, always. You need to recalibrate every year.
Yeah, I know, but in this specific case, could you do it? Like,
Yeah, absolutely. It could change from PD 0.05% to 0.08%. Or imagine from 0.05% to 0.10%. One supervisor can tell you it's the double.
Yeah.
It's a significant. I say, yeah, but the level is very low. Still, the credit rating agencies still keep it in AA, for example, at this level, and you need to show the way that you justify your solutions is the most important thing for being professional. Okay, at the first years of your professional career, you will listen a lot, and you will not have a lot of chance to talking with your partner and also with your clients. But you need to learn, because you are increasing your learning process. Okay? You need to be quiet, you need to learn a lot, and you need to write a lot. But you will have an opportunity to justify your solution. The way you justify, and you will have, when you are you have 3 years of experience or 4 years, you will have 1 minute. If you have the opportunity to talk to the CEO, etc., you don't have 30 minutes to explain. You need to develop your ability to explain the key driver, the key point in just 1 minute, okay? To capture the attention. And that's important, soft ability that you need to develop. I always talk to my students, you will have 1 minute, 1 go minute. So you need to take this opportunity, okay? Little by little, when you are going to grow in your company, you will have more opportunities. but in the end, the way they justify your solution, etc., is really important, okay? And you need to start from the undergraduate, okay? And also in the master, think how the real world works. Huh? So that's important, okay? So this is another one, sorry, I didn't know this. LTV is loan to value. Do you remember what I explained last week? Is your exposure at default divided by the market value of the guarantee. Okay? You need to re-estimate the loan to value every year. Okay?
And creating pair, what is creating pair?
Creating pair is, imagine that I purchase a non-performing loan of another bank. So a borrower that is in default, when I purchase, this is a good question. I'm going to ask you, Natalia, I'm going to explain and then one question. No worries, it's very easy. When you imagine investment funds purchase non-performing loans of banks, those borrowers that are in default are toxic assets for banks and consumes a lot of provisions and consumes a lot of regulatory capital. And banks have incentives to sell to investment funds. Imagine that an investment fund purchasing a non-performing loan, or another bank purchasing non-performing loan of other bank. This is a credit impaired because the exposure at default, the current debt, imagine is 80. And I purchase with a discount of 80% usually, so I'm going to pay, imagine 16 or 17. This is a credit impaired. When I purchase a credit impaired, should be classified in stage 1 or in stage 3. Do you understand what the transaction? Do you understand the transaction that I mentioned? Imagine that one bank has a borrower that still needs to pay 100 in order to more a number that is easier to fully understand. 100. And then this borrower is default. This borrower didn't pay the last 6 bills in the last 6 months. Okay? And the bank wants to sell this because need to increase the provisions, and this is an expensive profit and loss account, and try to sell this loan, and the investment fund is going to pay 20 for this loan, okay? And the investment bank or the investment fund has a notional amount of the debt of 100. This investment fund is going to try to recover 100 because this is a mortgage loan that the guarantee is around 80 or 80 or 70. Imagine the investment fund thinks, okay, I'm going to pay 20. I'm going to execute the guarantee because we'll have a court case. I'm going to execute the guarantee in 5 years, and then I will recover in 7 years because it takes a lot of time. And this toxic asset cannot be in the balance sheet of a bank some other time, and the banks do not have a lot of people for going to every court case, no? Because the banks have millions of contracts. Eh? So in this case, I paid 20, and I say, I'm going to recognize following the IFRS number 9 because for this investment bank should apply also IFRS number 9, should classify this loan in stage 1 or in stage 3? 1, because from the beginning I paid less than the notional amount. I will try to recover everything. Okay, I have a right to be paid 100, but I paid 20, and I recognize in 20. I change this loan to stage 2, whether when I purchased the PD was 20%, and if the PD increase to 40%, I will move this loan to from stage 1 to stage 2. But at the beginning, all the loans are classified in stage 1. Okay? This could be a question in the test that we need to make at the end of when Sergio and Maria finish this part, or if you want to do other day, we can do in advance, in March or whenever, or in February. Okay? From my part, very few questions, because from evaluating 10 hours, I don't know how to make it, to be honest, because it's very short. Okay? Okay, do you follow me? So in this case, what do you think in this case, Natalia? Good answer, eh? Good answer. Did you read it, or I can ask?
No.
Okay, so
Wasn't like the loan value the percentage of like if I'm like buying a land and like I have like 20% of the value like in cash, then that would be like a 20/80 loan value, or that was like
no. Loan to value means that the loan that I receive against divided by the market value of the guarantee that I provided you to the bank.
What was this condition?
80%, minimum,
Like 80/20?
maximum 80%.
That's still loan to value.
Yeah, loan to value. Maximum, right now the usual credit standard is maximum 80%.
For land or for like a property? I think for the loan.
For land, they are not providing credit to land.
They're not.
Usually it's very difficult.
Yeah,
In
yeah.
fact, I have a friend, a very good friend, that is developing some real estate luxury houses in Menorca, Ibiza, Marbella, and the first phase, he has a huge problem to obtain funding, and he's financing through Tram special purpose vehicles in Luxembourg, crowdfunding, loan crowdfunding in Luxembourg, but then he can move when he start to build the luxury real estate assets, etc. And he's finishing, he can obtain funding from the banks. But he needs, and he's paying a lot of interest rate, but if you don't pay this, you cannot promote.
I mean, there's like a different business model, like cooperative, you could like solve that issue, because you actually could like resale or like get the money from like the...
Absolutely. In fact, in Fitur Menor, you have some houses that were promoted by cooperative members. They created a cooperative and they promote this type of...
I think it's the same.
It works if you trust on the construction firm. It works, and it's very efficient for everybody. The bungalows that are close to the university were promoted in this type of cooperative. In fact, Javier Arellano and Mamen, the flat they have in the bungalow that they have in there is promoted as cooperative, developing a cooperative. It's very efficient, but
I mean, they have bad reviews. Like,
yeah.
I used to work like in a cooperative, like.
If you trust on the construction firm, is perfect. But from time to time, there could happen something in the construction firm, and then. But they were very so it was a very successful because these were very good quality, etc. It can be the case.
So in this case, I think like it will be good to like change it to stage 2 due to like the collateral.
Absolutely.
Value.
Although the collateral, but it seems that macroeconomic expectations and the ability to pay back the loan is getting worse, and then you need to move to PD lifetime. Okay?
So for the question Natalia had, so if I already buy like in stage 3, again it will always go to, you said the first one, right? The first stage. So if I'm a bank and I'm buying debt from a portfolio debt from another bank, and they're already like defaulting or whatever, those loans that I purchase go on stage 1, right? That's what
Yes,
you said.
that's right. That's right. You need to measure how it changes the credit risk from when you purchase. When you purchase, everything is stage 1. Okay?
If the PD is very high when you purchase it because it's already defaulted, how does it work? It is in stage 1.
Because you purchase and the price contains this information. The pricing you are paying with a high discount, and then you have this information. The important thing is how it changes, and the new information increase the credit risk. I don't mind whether the PD is 12% or 20% when you purchase. The question is whether there is a significant increase of the PD between when you purchase and when you are analyzing the loan in order to make the financial statements. You know what I mean? Huh? That's the important thing, okay? So determining increasing credit risk is very important. You can make a collective analysis. You can put together loans in Madrid region for specific professionals, for academics, etc. And then you estimate the PD and LGD, taking into account that all the firms or people in the portfolio should contain similar characteristics in terms of employment, profession, region, etc., etc. Okay, you have a lot of parameters because the number of portfolios is very high, very large in large banks. Okay, you can imagine that BBVA have more than millions of loans across Spain, Mexico, Turkey, etc., etc. So you have, and they need the information of the profitability of every loan. Okay, and then how is the opportunity cost? How is the profitability of this loan in comparison with others, etc. So imagine this case. After explaining you that the important thing is the comparison between the starting point and the date that we are analyzing the financial statements, what do you think in this case? This is for you? For you?
It's for all of us.
You can take.
No.
Mice made it.
I try to help this out. The problem of weight. They work very hard, but my life is really complex. So thank you very much.
It's the same question.
And what is your opinion?
Thank you.
Thank you.
I will increase the risk, I will put the loan stage 2, anticipating to what can happen.
So because of, you think that
Outlook.
you anticipated this information, so you contain this information in full, so the loan should be classified in stage 1 because there has not been significant increase in credit risk, right?
So on the firm side, let's say, let's say I have a credit line, a corporate credit line with the company of 20 million renewal, right, every 6 months or whatever. And this happens, this outcome. You still charge a premium on the next renewal based on interest? Like, let's say it was 5% and then you want to renew it as a firm, then they would charge you more because, okay, we see the macro outlook to be worse?
Good question, but there are two different worlds. The pricing, when you are going to renew this credit line, you are going to increase the pricing. And the other is the credit risk parameters. You can change the credit risk parameters every time that you analyze the portfolio. So in this case, is you have all this information, and at the time that you are granting this loan, you have this information. The only thing that is going to happen is that the pricing is larger. You are going to increase the pricing. But when you are granting the loan should be classified in stage 1. But your question is very interesting because you mentioned credit lines. I mean, the typical credit lines is 1 year. But imagine credit cards that is 1 month. They don't renew if you don't pay. Should we use PD 12 months or PD lifetime? In these products that the maturity is lower than shorter than 1 year, we call PD lifetime because the lifetime is it's shorter than 1 year. You know what I mean? Yeah? Shorter than 1 year, and then we can use PD lifetime for these specific credit receivables, credit cards, credit lines, etc. We need to estimate for these products because it's different.
And my second question is, and this is more on the bank side, because I was on the firm side. So, and if I have a good case on how something wouldn't affect me because my product has differentiation or whatever, internally the bank can make an exception, or it's like, okay, no, we're gonna modify the whole sector because we
Credit risk analysts are going to first, the head of the branch that you have interaction with them, you provide a lot of information. This head of this branch is going to send the material, all the information to the risk department. The risk department is going to analyze. Then you have an interaction. And then of course you can justify, okay, I have an asset in the balance sheet that the market value is much larger than the accounting value, is undervalued. So you can provide a lot of information in order to reduce the pricing. And you need to know that from a regulatory perspective, you can have a better price when you are audited by, especially for the Big Four. The Big Four, the consumption of capital for the bank is lower, so the pricing is going to be better. And the bank has more incentives to grant the loan to your company in comparison with other companies that is not audited.
I have a question. The banks work with, for example, consulting firms. Like, do they share information, or, for example, in order to understand about the mining community? Like, do they, like the bank, like need more information? So, for example, they contact like consulting firms that are experts in a sector, for example.
McKinsey, for example,
Yes.
or whatever, they have a lot of interaction with them. Also, they look at for the country at the IMF or look. They have their own research department. For example, EB have their own research department. Santander also have their own research department, HSBC, etc. But also have a lot of interactions with financial analysts. In Market Line, you have access to this database. There are some briefs, small brief reports about the expectation of some sectors. They, in order to analyze this, when they need to justify something, they need to provide to the expedient that they want to show to the supervisor the analysis they made. And in the analysis also the macroeconomic expectations. They need to show to the supervisor in order to convince them. Okay? And they are going to evaluate your internal models in order to develop. So in the internal models of the banks, you can see that there are a lot of people in your profile working in developing internal models in the bank. There are internal models for interest rate. For you would be better credit risk internal models, but also there are internal models for counterparty credit risk, for derivatives, etc., etc. Okay? You know what I mean? Okay. Any question?
Yeah, I want to understand what was your conclusion here? Is it that they had the information from the states?
When they are granting the loan, they have enough information, they have all the information, so this loan will be classified as stage 1.
How are we assuming they have the information? Where did it come from?
Because let me to
Like you said, the last word, the risk of default
Yeah, the coverage for the rules and the flows.
increased significantly. That's why I would say
The risk of the flows for the mortgage loans to borrow more like it would like to have significant increase in significantly. But this is just so I think this is in the same moment simultaneously. I assume that this is simultaneously. You assume that the bank granted a loan and then the macroeconomic scenario got worse and is getting worse. You can assume that you need to jump from stage 1 and stage 2. I assume that in this case you have all the information that at the same time. This is not in different stages, different time, different dates. Okay? But perhaps I wrong a little bit. So I don't see any word that gives you information about one date and additional information another date here. So, but if you think this, you can explain this in the exam, and it doesn't matter. For me, the most important thing is your professional adjustment. I don't mind the solution itself. What is more important for me is your professional adjustment, like the learning process.
I think I can like relate to this case a lot, but I have a question. Like, you that you know like more banks. Like, I'm a shareholder in a real estate development here in Rectory, and like we partnered with Banco Sabadell. Like, they gave us like access to a portal where we can like analyze like credit for our customers in corporate system. So they do require us that like the client, like the new homeowners, do get like a unemployment insurance. So like things like this like won't happen. Is that like normal in other banks? Like we require you to have like unemployment. It's like these people are.
But it was in the US or in
not
Spain?
here
In Spain. You have an insurance, employment insurance by the government here in Spain, but it has to
No, like Banco Sabadell requires us for our like the final clients to do get like that unemployment insurance.
Okay, because they want to hedge, then the credit risk of these people is going to decrease and the transaction is going to be accepted. Because here is like it's not a syndicated loan, but it's a loan for all these clients, right? To promote the houses of everybody.
Yeah, we do it separate credit.
Yeah, but in the end, the level of exposure is for everybody. They have the opportunity to say to 40%, no, we are not going to provide the credit, and 60% we are going to provide the credit. No, it's 100% for everybody, right? In this case, in a cooperative.
I mean, what we do is with the portal, we do have like a feature, and like if they need like some extra like more information,
Yeah.
they will send it. Like, we will send it to the bank.
Yeah, but the loan was for promoting the whole building,
One
right?
is for the land to buy the whole land, and the other one is individual for every single home.
Okay. And for the individual loan, they can reject to individuals the individual loan. They have the opportunity to reject the bank.
Yes.
In this case, okay. So I think this requirement should be in order to review the credit risk of people. If they are in default, the bank Sabadell can recover some portion for the insurance product, another for the.
But that's not a normal thing in other banks in the real estate industry.
No, this was a requirement because the first thing that they are going to ask you is your personal income tax comparison the last years in order to predict for your wife, your family, etc. The assets that you own, so the wealth that you have. If you don't have relationship lending with this bank, they are going to ask you about the deposit that you have in other banks, and then they are going to check the credit register, the CIBE. And then they are going to see whether you receive a loan from other entities in the past that they still is accruing interest. And if you are not performing loan in one of the banks, they are not going to provide credit. You know what I mean?
Yeah. But like, would it, like this kind of like insurance would like be helpful to be implemented in IFRS or just kind of?
No, this is not, IFRS is not going to require you. What is true is that it's less costly for the bank in terms of it's going to consume less regulatory capital because the credit risk is not covered, and it's going to consume less provisions because your loss given default is going to be reduced because of you have an insurance. They can ask you what they think. Sometimes you cannot provide the insurance product or whatever, and it's a question of pricing. But when they can reject the loan or they can approve. In order to it's different threshold when they are thinking about the pricing than when they are thinking about approve or is a logic, approve or reject. Or we can require more guarantees. For example, some from time to time to renew a loan, they ask you more guarantees, more collaterals in order to renew the loan. If you don't provide additional guarantees, because the guarantees have decreased in the market, the market value have decreased in the market, they can ask you for more guarantees, but if you cannot provide more guarantees, they are going to reject the renewal of the loan, you know, the rollover of the loan, or the rollover of the credit line, as mentioned. If the environment, the macroeconomic environment is getting worse, in order to roll over the debt, they are going to require more guarantees. And then this is important to explain that the bank is not liable when they are requiring more guarantees because the bank needs to defend its position. So the bank should work for the shareholders. And if the bank improves the position asking for more guarantees, it doesn't matter that they renew the loan because of the position before and after is different and has been improved. You know what I mean?
Maybe it could backfire because less people will be granted loans, I guess, and if they make money out of like the interest, the more people they have that with the bank, like the more profitable the bank is.
Well, but in the end, it depends on loan loss provision, it depends on the evolution of credit risk. When the banks anticipate that the macroeconomy is getting worse, they reduce the supply of loans because you can hit the economy through a huge amount of supply of loans, and then the credit risk is going to appear because you were more flexible on those borrowers that have worse credit risk rating. And then we always say that, remember the graph that I showed you, there are two things that you need to take into account when you are evaluating the banking system. The supply of loans in the economy, you can hit the economy, but in the end you are going to pay for this. And also the provisions that you have to cover the expected losses. Provisions are for expected losses, regulatory capital for unexpected losses. Do you remember? And that's important. So, okay, we are going to make a break of 15 minutes, okay? And then I will be back. I'm going to upload the... Can we talk after the break? I need to upload.
好，你困吗？去吧，去吧。确实太反抗了。